Good morning, everybody. We'd like to thank you for coming for taking time out on this first Saturday of spring. We're so excited to have you. We have a lot of information that we'd like to share. And we're not selling anything. Sorry to disappoint. Our goal today is to have a discussion, basically to go into some interesting statistics and what they might mean for you regardless of your situation. We hope that this is going to be the first of many informational seminars. And that being said, we ask that you please hold any questions until the end. We always try to end on time, and afterwards we'll be able to sit down and address any individual questions in that regard. So I'm going to go ahead and start with some introductions. To my left, we have Grace Rudowski. She's a licensed real estate broker, as well as a certified seniors advisor. So what does that mean? It means that she's gone through particular licensing that addresses the particular requirements that seniors have, right? So it's seniors, your typical home buyer, they have special requirements, special needs, and Grace has gone through all the proper steps to be able to address those. She combines this with her experience as a certified financial planner, and with almost 20 years in the business, she's a veritable vault of information. Behind you have Casey Fleming, a mortgage broker with C2 Financial Corporation. Casey started out in the business as an appraiser, which he did for 17 years, before moving into the lending business, and in August it'll be 20, if I'm not mistaken, 20 years as a lender. He is also the author of The Loan Guide, How to Get the Best Possible Mortgage, which is available on Amazon. And in our opinion, he is the leading authority on lending today. Which brings me to myself. My name is Eric Rudowski, and yes, this is my mom. I was licensed as a real estate agent right after I graduated from high school, and I currently study finance at San Jose State University. I believe that a home is the most valuable investment that people make in their life, whether it be an individual or a family. And so I'm really honored to have the opportunity to stand here in front of you today and offer my services, and really our services, so that we might help keep everybody a little bit better informed. So why are we here? As I mentioned, we're not selling anything. We aren't here to tell you what to do, but rather to keep you updated and informed. For this reason, we've created a network of professionals who we collaborate with and allow us to better serve the needs of our clients. This network of professionals includes real estate brokers, mortgage advisors, certified public accountants, social security experts, and financial advisors. So what that allows us to do is leverage the knowledge of all of those involved and make sure that our clients have access to the information that they'll need to make informed decisions. Our belief is that so many people are underserved, and this seminar is one way for us to curb that trend. And so now I'm going to speak a little bit on something I know about, which is the millennial generation. So millennials have a big impact on the real estate market, but they're not buying homes like they used to. And why is that? Well, housing affordability has gone down. That means for one reason or another, whether it be the mortgage payments, the responsibility of owning a home, the upkeep and maintenance of said home, or a number of any other factors, millennials simply don't want to make that jump into purchasing a home. In addition, the minimum required income has gone up by about $40,000, which simply means that the income isn't there to support their decisions. For this reason, renting has become a lot more attractive for millennials, and people who own a home now probably shouldn't expect the pot of gold that they might have expected in years past. An interesting statistic on this is that in the Inland Empire, which is around Riverside area, only about 35% of millennials are expected to have a full-time job. And so you can imagine what that's going to do as far as income and housing. At this point, I'm going to turn it over to my mom, who has information about a little bit different generation.
Yes, thank you, Eric. Let's talk about baby boomers. Baby boomers are generally defined as those born between the years 1946 and 1964. And this slide illustrates how 4 million baby boomers retire every year. When you do the math, it breaks down to 1 in every 8.5 seconds. So it's an impressive number. And they will have influence on So Silicon Valley housing inventory and median prices are on the rise. Santa Clara County leads the way in year-over-year gains. It's actually 49% jump. However, new listings drop in all reported counties compared to last year numbers. Average price increased by 28% year-over-year by around 300,000 and 14% compared to January 2015. In other words, based what we are seeing in Silicon Valley market, 2015 may be the peak year in short term to sell your home at the highest price. Let me say it again. 2015 may be the peak year to sell your home at the highest price. Now let's take a look at housing market. Housing market is underperforming given fundamentals like low mortgage rates and job and income growth. Sales actually were off 7.6% in 2014 compared to 2013. Share of first-time buyers is extremely low. So California has three housing gaps. It's affordability gap, home ownership gap, and housing production gap. So this graph illustrates housing affordability. The red line represents national statistics. The green line represents California statistics. As you can see, it's sharply down in California, what means that only 30% of households in California can buy a house. In Santa Clara County, it's even worse. It's only 22%. So, as you can see on the next slide, this affordability went sharply down since 2012. Homeownership gap is between California versus United States is 10% because the growth of home prices has been far greater than growth of income in California. And we also are dealing with inadequate housing supply. Simply said, we are not building enough houses.
At this point, I'm going to take over and introduce a concept called right sizing. So what does right sizing mean? Some of you may have heard the term downsizing, which is basically going from a big home to a small home. Right sizing is a little bit of a different take on that, and it basically means taking your own home and moving into something that better serves your needs. The example that we have is actually a transaction that my mom and I worked on last year. Our client was by the name of Mary Ann, and she was a practicing medical doctor. She was approaching about 70 years of age. She had a particular situation because she lived in a two-story townhome and it no longer served her needs. As you can imagine, the stairs became a problem, and in addition, it was almost 2,000 square feet, which simply wasn't room that she was using. So our challenge was to find her something that was going to be single level, and realistically our goal was to get her into a single family home, which we were able to do through diligent market research, taking a look at homes that came onto the market every day, because that's what the market was doing at the time, as well as our marketing techniques, which allowed us to reach homeowners directly. So what was our triumph with Mary Ann? She was able to go from a two-story to a one-story, and from a condo to a single-family home. Her mortgage payment increased slightly, but it wasn't something that she wasn't able to handle, and her quality of life increased tremendously because she no longer had to deal with stairs. The new home was
in that place in their lives where they're ready to move into a smaller space. So let's first talk about expanding or remodeling. There's a process that you want to go through that's going to yield the best possible results for you. And this is a general outline of the things that I recommend that we do. Start is, what you really want to do is figure out what your requirements are. And I would spend a great deal of time on this, especially if you're going to expand, because it tends to be fairly expensive. Think about all of the amenities you want. How many bedrooms, how many bathrooms, how large a kitchen do you want, or what do you want in your kitchen. Really spend a lot of time on that. Eventually what you'll do is you may find that what you want is not necessarily something you can afford, and then you can scale back. But the important thing is figure out everything that it is you want and need, and then maybe rank them in the order of importance. And then make a plan, and often what that really means is literally find an architect and get a floor plan drawn up, an architectural plan. And then go out and get bids. One of the things that's most important about the bidding process is different contractors will use, they'll want to use their own contract. And the problem with that is that their own contract may or may not include the terms that protect you. So one of the things you're going to want to do is find a contract, either from a consultant or from an attorney or even online, and make sure that all of the contractors use the same contract when they bid out your project, and that way you're going to be protected. I added check value add here. As Eric pointed out, I spent 17 years as an appraiser. One of the jobs that I did as an appraiser was feasibility studies. And what that means is people would come to me with plans and say, is this economically feasible? If I make these, if I expand here, or if I add here, or if I do this remodeling, am I going to get all my money back? Now, I'm not necessarily in favor of only remodeling or expanding for the purpose of getting your money back, because there's other reasons to do it too. But I think it's a really good idea to check that value out, and there's an easy way to do this. Hire a competent local appraiser, and then have them give you 2 appraisals on your property, one as it is, and the second one subject to if you did whatever it is that you are contemplating doing. And what they'll do is you can compare those 2 numbers and see whether or not the amount of money that you're going to spend is going to yield 100% return, or less than that, or more than that. Finally, hire a contractor, again using your own contract. And we're going to talk in a minute about financing options. But this is the basic steps that you would use if you're either going to expand or remodel or reorganize. Now, for moving up and moving down, I work with an awful lot of families who are doing both. And again, it's not that much different than expanding or remodeling. The very first step is really to define and refine what it is that you need. In this case, in particular, size, amenities, location. It's even more important to start off with an exact requirements list because real estate transactions are very expensive transactions. So you want to make sure that you only do it once. You don't want to have to do it 2 or 3 times. So what you want to do is make sure that you know how much size you need, how many bedrooms, how many bathrooms, do you need a pool, do you need enough space for a pool. All of those things are very important. And location. Growing families are very, very concerned about school districts, and folks that are downsizing might be more concerned about how close amenities and hospitals are. Then determine your budget. Now, I pre-qualify people all the time, and one of the things, especially here in Silicon Valley, that I find is people often will qualify for a lot more home than they're comfortable paying for. So I ask, really, there's 2 questions. How much do you have in cash and how much do you make? Is one set of questions, and that tells me what people can qualify for. Then I ask the second question, what are you comfortable with? What are you comfortable spending up front? And what are you comfortable spending every single month? Now, in my experience, even relatively conservative buyers ultimately end up somewhere above what they're comfortable with and below what they qualify for. Because once they get out of the market and they get real, they see that that's what they have to do. The next step is to get pre-qualified and actually pre-approved. In this market, in Silicon Valley, no one's going to take an offer seriously if you are not pre-approved, because there's so many all-cash buyers and so many people that are pre-approved that they're just going to toss your offer out. And then go shopping. That's when it's time to So, getting the best financing possible, this is something I'm very, very passionate about. It's very important to me that you as a consumer get the financing that you want. And here's why. Your mortgage is the most expensive thing you will ever take on. Now you might think the house is the most expensive thing you'll buy, but you'll actually spend more money on the mortgage than you do on the house in most cases. So truly, the mortgage is the most expensive thing you will ever take on in your entire life. So you ought to get it right. You ought to have more and better information than you ever had before. So I want to talk about the options. I want to talk about which option is right for you. Now many folks think, well, this is the only kind of loan that we should get. But if one loan was perfect, then there would only be one loan. And there isn't. There's a lot of different loans for a lot of different circumstances. And then where do you go? There's a lot of different potential sources for getting a loan. I want to talk about the advantages and disadvantages of each. So first, financing options. And this is both for remodeling and expanding as well as for buying a home. But some of these are more relevant to refinancing. So first is a conventional mortgage. If you're buying a home, this is usually the way you're going to go. And that's just your standard 30-year mortgage. Could be fixed, could be adjustable, where you bring in a certain amount of down payment. Could be anywhere as low as 3%, as much as you want above that. The advantage we're going to talk about conventional mortgages in a bit. You also can finance with an equity line, particularly with when you're doing construction or expansion or remodeling. Equity lines can be a really good way to go. Construction loans are a little complex, but sometimes they're the best way. Sometimes they're the only way to go. And then finally, you can actually use a reverse mortgage both to finance an expansion and remodel, as well as to finance a purchase, something a lot of people don't know. So we'll talk about that. So let's talk about the benefits, costs, and risks of each option. With a conventional mortgage, if it's a fixed rate loan, the biggest benefit is that your interest rate will never ever change. It's fixed for life, the payment is fixed for life, you're done. It's a fully amortized loan. You're going to pay your loan down over time as you make your payments. Your interest rates are very, very low right now, historically low. They're not the lowest they've ever been. They're not quite as low as they were in April of 2013. But from an historical perspective, they're just a hair over that. The disadvantages are, one is you have to qualify for the loan. You have to have enough reserves. You have to have enough income to pay for it. You have to have good credit. You have to have good equity in your property. So it's not everybody qualifies for a conventional mortgage. It's also the most expensive loan out of all of these. Certainly more expensive than an equity line, typically, and more expensive than some other options. Your payments are higher than an equity line, usually. And it's a lot more expensive than an equity line to acquire. So when you're talking about putting it in, if you're considering this or an equity line, the equity line is a lot less money up front to put in. All right, so let's look at equity lines now. Now, with an equity line, the biggest advantage is it's very inexpensive to acquire. As a matter of fact, many small community banks and credit unions will do it at no cost at all. The minimum payment is interest only, usually for the first 10 years with most of them, which means your payment is very, very low. You can draw on it if you need to, so when you put an equity line in place, you don't have to take the money all at once. Interest rates are very low right now as well. Most equity lines are based on prime, and there's a margin that might be as low as 1 over the prime rate, or as high as maybe about 3, depending on your circumstances. Prime rate today is about 3.25%, so prime plus 1 is 4.25%. Very, very inexpensive for what is generally used as a second mortgage. You have to qualify for this loan. You have to have the income, the assets, the equity to be able to qualify. The interest rates are variable, and eventually they will rise. Do we know when they're going to rise? No, but they will rise. And eventually, you're going to have to pay off the equity line. Typically, the way equity lines are structured, the first 10 years are interest only, and that's the draw period. You can draw on the equity line for the first 10 years. After that, you'll have typically 15 years where you have to pay it off, and it's locked at that point as far as you won't be able to draw any more after 10 years. And the things to watch out for is the margin and the floor. So the margin is defined in your contract, and determine what your rate is every single month. And now, after the interest rates went down as low as they did, many of the lenders out there include another term in the equity loan contract called a floor, meaning it can never go below a certain amount. What's common is 5%. But there's a lot of lenders that don't have that floor. So if interest rates go up and then come way back down again, you don't want a floor in your contract. So watch out for those two terms. For construction loans, this is the most complex loan product available. The greatest advantage to it is that you don't have to have the equity in your home currently in order to get it. So let's say you have a $400,000 home and you owe $320,000 against it. So you already owe 80%. It would be very difficult for you to draw much money out. But if you have, let's just say for the sake of argument, a $200,000 remodeling and addition plan, and that's going to increase the value of the home $200,000. On the construction loan, the value they will use to determine whether or not they're going to give you the loan will be the as completed value. So they look at the future value after the construction is done. So you can borrow, when you can't borrow any other way, the construction loan is a fantastic way to go. Another advantage is that the lender manages the cash outlays for you. They hold all of the money for the construction in an escrow account. And then as work is completed, piece by piece, they dole the money out. Now this really protects you. Not only do you not have to manage it, but this really protects you. When the contractor comes and asks for a payment, they can't get the payment until the work is done. So you no longer have to have a fight with the contractor about whether you're going to pay them or not. All you have to do is say, sorry, the lender won't pay you yet. You have to complete the work before you get paid. We have fairly competitive interest rates on construction loans. Yes?
Can I ask a question?
Sure.
Does that mean that, let's say, for example, if you're in the process of a construction loan for an existing property that you're in, and you want to do some changes, that this is what the construction loan will cover? Okay, not just the purchase.
Correct. You can use a construction loan for remodeling and addition and adding on to a home you're currently in. You can also use a construction, what they call a purchase construction, acquisition construction loan, to buy a piece of property with plans to expand or remodel.
Okay, so that the purchase one would be like what you use on a 203K plan?
Could be. 203K can be used either way.
Okay. And then the other question that I have is, so if you were remodeling your own home, and let's say they find out, I've been watching HGTV, so if they find out there's some major foundation work that has to be done that wasn't included in the price, how does that work? In the construction loan?
Yeah, let's address this afterwards because what you've brought up is a very complicated issue.
Okay.
It's essentially, there's steps you need to take to make sure that doesn't happen.
Right.
All right. Disadvantages to a construction loan is it is a higher cost because of the administrative overhead. The lender's going to be doing a lot of work. They want to be compensated for that. You pay the interest on the entire balance from the very beginning, whereas with the equity line, you only pay interest on what you've drawn out. So if you draw out money over time to pay the contractor, you don't start paying interest until you use the money. With a construction loan, you pay interest from day one on the entire amount. And you don't have any control over the money in your escrow account, and you can't access it. The lender controls it. And when all of your construction is done, you have to replace the loan when you're done with your construction. So it's not a permanent loan. So at that point in time, then you have to refinance into a new loan. Okay? And let's talk about reverse mortgages. So with a reverse mortgage, what ends up happening is this is for people only over 62 and up, and you have to have a fair amount of equity in your home. And the best thing about a reverse mortgage is that no payments are ever necessary. So a reverse mortgage can either be a lump sum, a credit line, monthly payments. There's a lot of ways to structure it. But essentially, the essence is this: is the loan is made to you. It accrues, interest accrues, the principal balance grows, and the money is not due back to the lender until either you pass away or you've been out of the property, lived outside of the property for at least 12 months. You can use the equity line to pay off an existing mortgage and and this is fairly common now, it's getting more common. You sell your existing home, take all of the equity that you have in your existing home, buy a new home, even if you can pay for it cash, 100% cash, put a reverse mortgage on the property as you acquire it, and then you can have monthly draws that are set, or you can just simply have an equity line. So you don't need to qualify. You don't need to qualify with income. You don't need to qualify with credit. You don't need to qualify with assets. All you have to have in order to get a reverse mortgage is you have to be 62 years of age, and you have to have enough equity in your home to structure it. You don't have to even qualify, I said that. It is the most expensive loan to acquire. And why is this? This is because these loans right now are insured by the FHA. And what the insurance pays for is this. There were a lot of horror stories in the past where reverse mortgages were made to seniors, and when they passed away, the family discovered that they owed more to the lender than the home was worth. What the FHA insurance pays for is, if that ever happens again, and the principal balance of the loan is greater than the actual value of the property, the FHA mortgage insurance pays the lender for the losses. So the family does not owe the lender more, even if the home is upside down at the time of death. So it's very expensive to acquire because there's mortgage insurance required upfront. Some equity is eaten up if you don't make payments. Today they are structuring reverse mortgages with the intention that, using a fairly reasonable assumption, you're never going to eat up all of your equity. But of course, we never know if there's going to be another housing crash. And again, watch out for the margin. This is one area, this is the only loan product left where the lender can put almost any margin they want on it. And what they do is loan officers are compensated more if they put a higher margin on it. And you won't know as a borrower, typically, unless you understand what you're looking for and you read the paperwork. And what happens with a higher margin is that the balance accrues faster and your equity is eaten up faster, and there's less left over when either you pass away or you decide you're done living in the house and you want to sell it. So watch out for the margin. Where do you go? Sources. You can go to a large bank, big banking. You can go to a community bank. You can go to a mortgage banker or a mortgage broker. Let me explain what each of these is. So a big bank, you know what it is. Go ahead. Next slide, please. Sorry. Big banks, you know what they are. They typically will have the most broad product lines, particularly with conventional mortgages. They typically don't have niche products, maybe stated income or certain types of investor products or certain types of adjustable rate products. But they do have a very broad selection of conventional products. They will tend to make concessions for cross-marketing opportunities. So if you are a high net worth individual and you have maybe $500,000 that you want to put in the bank might actually give you significantly better pricing, might even take the loss on the loan in order to get that deal in the door. They can be a little bit flexible up to a certain point because they have the discretion of being able to say, well, we're not sure about your income, but we'll accept it. But they do sell loans just like everyone else. All of the big banks sell their loans to Fannie Mae, Freddie Mac, just like everyone else does. So that discretion is limited to a certain amount. The disadvantage is that a no is a hard no. When a bank tells you no, you're done there. That's it. That means they have no product that's going to be able to help you with. They do have more management, more overhead, and as a rule, they're much more expensive. Unless, of course, like I say, there's cross-marketing opportunities they're interested in. The other disadvantage is they do not have to disclose what they earn. Basically, they only have to disclose to you what it is that you're going to pay for. So it pays to shop. Let's go to community banks, and also this includes credit unions. In many ways, the product offerings are very similar to the big banks. They have about the same blend of product offerings. They'll have more customized service and advice, and they usually have better pricing because they have less overhead, less management, particularly when it comes to credit unions because they're nonprofit. But a hard no is still a hard no. Once they say no, you're done. They can't help you. And they too do not have to disclose what they earn. Let's talk about mortgage bankers. So when you go to a mortgage company, ABC Mortgage or XYZ Mortgage, you may not know whether you're dealing with a mortgage banker or a mortgage broker. In truth, there's really very, very little difference. These companies, a mortgage banker will lend the money to you in their own name. They'll close in their own name, they'll fund their own name, the documents are all drawn in their own name. But they'll sell the loan off within a month or two. They actually pre-sell the loan before they make it, so they know exactly what investor it's going to. They typically have the most product lines, including niches. They can shop a few lenders. Most mortgage bankers will work with probably 4 to 8 different investors that they sell to. So depending on what kind of products they're selling. A no is a soft no, meaning that once they get a denial for a loan, they can usually try one of their other investors to see if there's a product that will accept you. And they can lower the price to meet competition. So mortgage bankers, if you end up, if you're in a purchase situation, you're getting down close to close, a mortgage banker actually does have the ability they have the discretion to be able to lower their price to meet the competition if it's necessary. They don't have to, but they can. And they also do not have to disclose what they earn. Again, that's kind of a theme here. The difference with the mortgage broker is a mortgage broker does not fund in their own name. A mortgage broker has many lenders, anywhere from 10 to 60 or 70 or 80, and they shop the loan for you. And what they do is that when the mortgage broker does a loan, it's actually the docs are drawn and they're funded in the name of the lender that's doing it. They have access to all product lines, all niches. If a loan is out there that suits your needs, they're going to be able to find that. We still do not have a good source for bankrupt pyromaniacs who are unemployed. But pretty much everything else we can do. A no, therefore, is rare. It's very rare for us, as a mortgage broker, it's very rare for us to say no, because usually we have a source somewhere that will do it. It might be pricier than, for instance, if you had perfect credit, but we can get it done. Usually with a mortgage broker, they have the best customized advice, and let me explain why that is. With banks and mortgage bankers, because they have large overhead, they don't pay their loan officers that much. So a loan officer, in order to make a very good living, needs to close 10 or 15 deals a month. With a mortgage broker, we have very low overhead, we're very nimble, and so with mortgage brokers typically attract their loan officers by offering them a much higher commission. So a mortgage broker, a loan officer at a mortgage broker shop, needs to only close maybe 4 or 5 deals a month in order to make a good living. And the reason that's important is they have a lot more time to spend with you. So as a rule, loan officers working for mortgage brokers are better educated, they spend more time with you, they spend more time shopping for products because they have more products to shop, and they're better able to give you customized advice. They usually have the best price, at least on the first quote, because, again, we shop dozens of lenders and we can usually find, there's always some lender out there that's a little bit hungry. Everybody gets their money ultimately from the same pool as it trickles through the system. But there are some lenders that will take a lower margin on their piece of it because they're a little bit hungry for business at that month. We must charge the same. A mortgage broker has to charge the same on every loan. Since 2002, we have absolutely no discretion whatsoever on what our margin is. Our price is our price. It's just the way it is. The CFPB dictated that. And we have to disclose what we earn. So you'll always know what a mortgage broker has earned on your loan. And then finally, I want to end up, there's a few marketing scams that really get people. They really hook people in, and I like to talk about them. So you've probably heard a lot of radio ads where they explain that they have no lender fees. We don't charge you any fees, no points, no fees, no costs, anything else. And the implication, of course, is that they're working for free. Well, we all know that nobody works for free. We all know that the money is built in there somewhere, and where it's built in is the interest rate. So be aware that any lender can make almost any loan, and by selling a higher interest rate, pay for all of your upfront fees and points upfront. Any lender can do that. A good lender is going to give you that option, as well as give you the option to pay some fees to get your insurance, so you don't have to. Very large national mortgage banker is doing that now. Nobody likes mortgage insurance. So of course, this is a very attractive offer when people say, we're not going to charge you any mortgage insurance at all. But how do they do that? Well, obviously, again, there's no free lunch. What they do is they raise the interest rate and use the additional payments to pay your mortgage insurance on your behalf. But here's the trick. With mortgage insurance, you can usually get rid of it as soon as you have at least 20% equity, subject usually to a 2-year minimum. So eventually, you can make a mortgage insurance payment go away. But if, in order to pay the mortgage insurance, you take on a higher interest rate, the interest rate's forever. It'll never go away. Is it a good deal? It actually can be sometimes, but don't get hooked into thinking that the mortgage insurance is now free, because it is not. You'll see a lot of advertisements that claim that they have government-authorized loans. The government doesn't authorize any loans. Fannie Mae and Freddie Mac buy loans from everybody, and FHA insures loans from everybody, and the VA guarantees loans from everybody. So we all have the exact same pools of government money that we can attract. Special.
What does that mean then?
What that means is when someone claims that they have government authorized loan programs, this is used a lot when targeting veterans. What they are implying is that the VA has authorized them to reach out to the veterans. Or you'll see FHA loans, you'll see lenders say the FHA has authorized us to reach out to you and make low down payment loans. Well, every lender can do that. Every lender, banks, community banks, credit unions, mortgage bankers, and mortgage brokers, we can all do it. So just don't get caught by that and think that somebody has, for instance, a special or unique source of funds. Every source out there will sell to anybody who can put a loan together. Because why wouldn't that? And then no income documentation. The CFPB has made no-doc loans illegal for single-family residences. For any home that you're going to live in. So if it's your own personal residence, there is really no such thing as no income documentation loans. Now, what you'll see people say, well, give us your bank statements, we'll track how much money you've made, and we'll use that to document your income. But they're going to have you sign a form. The form is called the 4506. And it's a form that authorizes the IRS to verify what you've paid. So if you sign a loan application that says you make $100,000 a year, and then sign a form authorizing the IRS to audit, to tell them how much you make, then you've committed fraud if you make less than $100,000 a year, and the lender that your mortgage broker or banker sold the loan to can then call the loan. They can just call you up and say, sorry, the loan's due, send us a check. So be very, very wary about no income doc loans. Now, no income documentation loans are available, and they are perfectly legal on income properties.
So at this point, as you can see, we covered a wealth of information, and really it's just the tip of the iceberg. There's so many different circumstances that people encounter and so many different situations that one of us might want to address. So there's lots of options to consider. And so at this point, I'd like to open it up to any questions, and whatever your needs are, let's talk about it and see what the right option might be for you. So I can put up the contact information for Grace and Casey, and as I mentioned, any questions you might have